What's up, traders, and welcome to another installment of the Market Barometer Fundamental Analysis series. In this video, we're going to be talking about solvency, and specifically the financial ratios that help us measure solvency. When we gauge the solvency of a company, it helps us to answer questions like, how capable is this company of meeting its debt obligations? It also clues us into a company's capital structure. How much debt does it have relative to its equity and to its assets? So again, there are a ton of different financial ratios out there, each of which gives us a different glimpse into company performance. The specific ratios we're going to be talking about today are all related to solvency. We're going to talk about the current ratio, the debt to assets and debt to equity ratios, as well as a company's total debt, and what these ratios tell us about a company's financial condition. Understanding a company's solvency and how to gauge that solvency is another important piece of the puzzle as far as performing our fundamental analysis. When used in conjunction with the other categories of fundamental analysis, those being valuation, profitability, and growth, we're able to form a deep understanding about these companies and their relative attractiveness as investment opportunities. So without further ado, let's jump in and talk about solvency. Solvency in general just refers to a company's ability to meet its debt obligations. It also refers to a company's total debt level and the leverage that it employs. So in regard to its debt obligations, we're talking about making payments, both principal and interest payments on things like loans or against any bonds that a company has issued. Total debt just refers to the absolute value of the debt that a company has accumulated, while leverage refers to the relative proportion of a company's debt funding to its equity funding. Now that's a big part of what a company's capital structure is. How much of the company was funded by debt and how much of it was funded by equity. Now, again, debt just refers to, things like loans and bonds, capital funding that a company receives but has to pay back with interest. Whereas equity refers to a company selling shares of ownership in itself and receiving cash in return. So a company doesn't have to pay back capital sourced from equity funding, but it does relinquish some portion of ownership control over itself and an equivalent portion of future potential profits. And in that regard, sourcing capital from debt is often favorable to sourcing capital from equity. But when a company accumulates too much debt, servicing that debt or making the principal and interest payments can cripple future business operations. This is known as becoming over-leveraged, when the total level of debt gets out of proportion, out of balance with equity. Or consider a situation where a company takes on a bunch of new debt, but isn't able to turn around and generate enough revenue from that debt in order to service that debt. Companies typically use the capital source through debt and equity funding to purchase new assets that are then going to be used to generate revenue. If a company's revenues and profits is insufficient to service that debt, they're all of a sudden at an increased risk of default or full-on bankruptcy. So what a company strives to do is to find that premium blend, that perfect mix of debt and equity funding to fund their business operations without accumulating a crippling amount of debt and while also not relinquishing too much of the potential future profits. Now that we understand what solvency is a little bit better, let's talk about the specific financial ratios that we're going to be using to gauge company solvency. First up is the current ratio. Now, the current ratio takes current assets divided by current liabilities. It's a measure of liquidity that indicates a company's ability to pay its short-term debt obligations due within 1 year. The current assets and current liabilities can be found on the balance sheet from a company's financial statements. So let's talk about the two components of the current ratio. First of all, we have current assets. Now, current assets refers to liquid assets, right? So things like cash and cash equivalents, accounts receivable, those assets that are either cash or that are easily converted into cash, because these are the assets that a company has available to service its debt obligations, to make its principal and interest payments. It's not reasonable for a company to sell a big piece of equipment and then take the cash from that to pay off its short-term debt obligations, right? So when we talk about current assets, we're talking about those things that are cash or cash-like in nature that a company owns that it can use to pay the current portion of its debt obligations. And that's exactly what current liabilities, the other component of the current ratio, refers to. That portion of a company's total debt that's due within 1 year. So So when a company takes out a new loan or makes a new bond issue, the company doesn't have to pay all that money back right away. It pays it back in installments, right? So principal and interest payments associated with that debt. And a certain portion of that debt comes due each year. So current ratio is specifically looking at the amount of a company's liquid assets relative to the portion of its debt that it has to pay that year. Obviously, you want to have enough cash on hand to pay your bills, right? So that's basically what the current ratio is looking at. Does this company have enough cash to pay those bills that are coming due this year? So the higher the current ratio, the less at risk a company is of not being able to pay its bills. But again, a company wants to find that perfect blend of debt and equity financing. So a current ratio that's significantly higher than its industry and sector competitors is going to tell us that maybe management isn't using enough leverage. It's not using enough debt to purchase its assets, and in turn might not be generating an attractive return on those assets. So what's a healthy level for the current ratio? Well, again, that's going to be highly dependent on the company's line of business, the industry and sector that it's in. So what we're going to be looking for is a current ratio that more or less falls in line with industry and sector averages. We'll also want to put this ratio in the context of some of the profitability ratios. For example, if a company has a higher current ratio than its competitors, it might be less risky, but we'll also want to ensure that it's producing adequate return on those assets. And conversely, a company with a lower current ratio than the industry average might be at greater risk, and we'll want to make sure that we're being compensated for that increased risk with a greater return on assets. And we'll be talking more about return on assets and the other profitability ratios in the profitability video later in this video series. Next, we have the debt to assets ratio, also known simply as the debt ratio. This takes a company's total liabilities and divides them by total assets, right? So total debt divided by total assets. It's a leverage ratio that shows the degree to which a company has financed its assets through debt. As with the current ratio, the debt ratio is derived from the balance sheet. So this is most useful once again as a comparison metric. It's going to help us compare the relative leverage that a company is employing to that of its industry and sector peers. So again, this is something of a double-edged sword, right? Too much debt and a company is at greater risk of not being able to meet its debt obligations. Too little debt, too little leverage, and a company won't have attractive returns on its assets or its equity. So the debt to assets ratio is going to help us get an idea of how much leverage a company is employing relative to that of its competitors. And we'll want to put that again in the context of the return it's generating. In this case, the return is generating on its assets. To that end, the debt to equity ratio is similar. It takes the total debt divided by total equity. It's a leverage ratio that evaluates the degree to which a company is financing its operations through debt versus shareholder equity. Again, a debt ratio above industry and sector averages indicates a greater risk of financial distress, while a debt ratio significantly below the industry and sector averages might indicate that a company is over-relying on equity to finance its business, and that could be costly and inefficient. Lastly, we have total debt. This is just the total amount of debt that a company has accumulated. This is kind of an ancillary figure to the other ratios that we've already talked about, but there is some important information you can derive from this. And let me move myself out of the way here so you can read the description. But the trend of total debt indicates if a company has been paying down or accumulating more debt. So if you've seen that a company is accumulating more debt over the last several years, you're going to want to see that they're putting that debt to work. They're purchasing assets, and those assets are generating revenue. Otherwise, you'd want to see that a company has been paying down its debt and that its total debt level is decreasing. On the other hand, if a company's total debt level is decreasing, perhaps they're not investing in future growth and their share price might stagnate. Now that we have a better idea about what each of these financial ratios tells us and how they're calculated, let's jump into the market barometer and put some of this stuff to work. Let's see these things in action and do an example analysis of a company's solvency. All right, team, here we are back in the market barometer. We're in the fundamental analysis section, and I've got us on the solvency trend tab. This tab is going to give us access to all these solvency related financial ratios. It's going to give us the ability to analyze these ratios ratios, both looking at the historical trend for the individual company and then being able to compare and contrast that to the trend of the industry, sector, and market averages. So for those of you that are watching this video out of order or are still unfamiliar with how the software functions, I'll briefly go over what we're looking at here and how this operates. But just know that if you want to know more, check out some of the software specific tutorials over at marketbarometrics.com. But in short, in the top left here, you have your ticker selection. You're going to get the company name up in the top middle. And top right, you're going to get the sector and industry that that company is in. So right now we're looking at applied materials, which is in the technology sector and the semiconductors industry. So over to the left here, you have a bank of buttons. These are going to allow us to switch between the different financial ratios that in this instance are related to solvency. So we have current ratio, debt to equity, debt to assets, and total debt. Clicking any of these buttons is going to update the charts and figures to the right. So the charts and figures here, this is where the real analysis takes place. The topmost chart is the company itself, and the figure to the left is the year-to-date average of the financial ratio that you have selected for that company. Below that is the industry median of that financial ratio. Below that is the sector median, and below that is the market median. So I've just selected the current ratio again, and if you guys ever need a quick reminder what any of these financial ratios means or how it's calculated, just hover above the company name here in the top middle, and you're going to get that brief description for each of these financial ratios. So again, the current ratio is the current assets divided by current liabilities. It's a liquidity ratio that measures a company's ability to pay short-term obligations due within 1 year. And so again, in general, what we're looking for is a current ratio that's more or less in line with the industry and sector averages. Anything that's significantly above or below the industry median is going to raise a red flag, and that's the kind of thing that we'd want to look into further. So with a year-to-date average current ratio of 2.51, applied materials is more or less in line with the industry median of 2.93. And again, comparing a company to its industry is, to me, the most important comparison that we can make, because companies that share the same industry are essentially in the same line of work, right? Their businesses are going to be very similar, and they're going to be each other's direct competitors. So these companies make the most sense to make direct comparisons to the company in question. So right now with applied materials in the semiconductors industry, the industry median current ratio for the entire semiconductors industry is 2.93. Applied materials with a current ratio of 2.51 puts it more or less in line with its industry peers. So nothing really of note there. A current ratio of 2.51 essentially is telling us that for every dollar of bills that it has coming due, it has $2.51 worth of current assets, cash and cash equivalents to pay those bills. So applied materials should have no problem paying its bills in the short. Next, let's take a look at applied materials debt to equity. With a year-to-date average debt to equity of 1.35, Applied Materials is sourcing a greater proportion of its capital funding from debt than equity relative to its industry and sector peers. And that's something that's definitely jumping out at me and warrants further investigation. In general, a high debt to equity ratio like this, especially relative to industry peers, is indicative of increased risk. But with increased risk comes increased potential. When a company finances its growth with a greater proportion of debt, the important thing to know is that debt paying for itself? So taking on that debt, a company purchases assets. Those assets help it to generate revenue and profits. As long as the profit that the company is generating off the debt that it's assuming exceeds the cost of that debt, then generally a higher debt to equity or the more leverage that a company is employing can be beneficial and boost potential future returns. It's also important to note, though, that the cost to service that debt can change with changing market conditions. Well, for example, if prevailing interest rates rise, or for whatever other reason the interest rate increases on that debt, it might be more difficult for a company to service that debt, and it might become more of a burden, and it might fail to generate a return that pays for the debt itself. Next, we have debt to assets, and I suspect, based on what we saw from the debt to equity reading, that we're going to see a debt to assets ratio in excess of the industry and sector medians. And sure enough, that's exactly what we're getting here. With the average year-to-date debt-to-assets ratio of 0.29, Applied Materials is financing a greater proportion of its assets using debt. And really, I could say more or less the same things here as I did about the debt-to-equity ratio, where it's going to be higher potential future returns, but also higher amounts of risk associated with this company. So the next step from here would be to answer the question, okay, well, if this company is more leveraged, is financing more of its business with debt, has higher risk, I want to be compensated for that extra risk. I want to know that they're generating a solid return on that extra leverage that they're employing. And we could analyze whether that's the case by jumping over here to the profitability trend tab. This is going to give us access to all the financial ratios related to profitability. And again, we're going to go into more depth with this stuff later in this crash course series. But what jumps out at me right away is I'm here on return on assets. You can see that Applied Materials is generating, over 3 times the return on its assets than the industry median. Similarly, it's returning, almost 5-fold as far as return on equity relative to its industry peers. So Applied Materials is riskier, they're employing more leverage, but they're also generating a greater return on their assets and on their equities. So they're utilizing that extra debt effectively. Now that's a pretty substantial insight, and that's the kind of power that the market barometer brings us. So lastly, let's just talk about the total debt here. There isn't a whole lot of room to do any comparative analysis with total debt, because the total debt that a company has is going to vary depending on how big the company is, how big its market cap or its enterprise value is. So it's not very useful to compare this to industry sector and market medians. But what we can look at here is the trend in that debt. And looking at the yellow chart here, this is showing us that the trend in the total debt for Applied Materials has generally moved up and to the right over the last several years. So they're accumulating debt as opposed to paying down debt. And that pretty much falls in line with what we found so far. This company's been growing its debt, but it's using that debt effectively and efficiently generating returns off of that debt. There you go, folks. A quick look at the financial ratios associated with the solvency of a company. We talked specifically about the current ratio, the debt to equity and debt to assets ratios, as well as total debt. We use this information to do a quick analysis of Applied Materials' solvency situation, and we determined that Applied Materials is liquid in the short term. With a current ratio of 2.51, Applied Materials has plenty of cash and cash-like assets on hand to pay its short-term debt obligations. We also found that Applied Materials is employing greater leverage than its industry, sector, and market peers, with higher debt to equity and debt to assets ratios. But we also determined that it's doing a good job of generating returns off of that increased debt. So even though it might be more risky and more susceptible to changing market conditions than its industry peers, it's also doing a superior job of generating revenues and profits off of that increased proportion of debt. Again, solvency is only one piece of the puzzle. When we use these financial ratios in conjunction with the ratios associated with valuation, growth, and profitability, we can form a deep understanding of these companies and create a narrative that allows us to understand the driving factors of business performance. So if you guys like this video, don't forget to subscribe to the channel, hit that like button, comments down below, and until next time, thanks for tuning in. We'll see you guys in the next video.